All right, let's get right into it. Today, we're tackling a massive question for anyone investing in real estate. When a deal hits it big, where does all the money actually go? We're going to break down the super complex world of commercial real estate fees. So let's dive in. So picture this. You put $1 million into a shiny new skyscraper. The project is a huge success. But then you look at your bank account and the number doesn't quite match the headlines. What gives? Well, before you see a single dollar of profit, a slice of that pie goes to the managers, the people who actually put the deal together. The real question is, just how big is that slice? In just about any deal like this, you've got two main players. On one side, you have the limited partner, or the LP. That's probably you, the investor bringing the cash. And on the other side, you've got the general partner, or the GP. That's the sponsor, the one with the expertise to find the deal and make it work. This whole thing is a partnership between money and know-how, and it's all built on a very specific financial agreement. And that's exactly where fees come into the picture. But don't just think of them as a cost. Really, it's the price of partnership. This fee structure is basically the engine of the entire deal. It defines exactly how the manager, the GP, gets paid for their time, their expertise, and most importantly, the results they're supposed to deliver. At its very core, it's pretty simple. These fees are there to pay the general partner for all the specialized work they do, from the beginning of the investment all the way to the end. They get paid for finding a great opportunity, for doing all the nitty-gritty due diligence, for managing the asset day to day, and, hopefully, for pulling off a profitable sale. So what are these fees exactly? I find it's helpful to think of it like a menu at a restaurant. Pretty much every service the GP provides from start to finish has its own line item. Let's take a look at the most common things on that menu.
First up, you've got the acquisition fee. This is a one-time charge you pay right at the beginning, at closing, and it covers all that upfront work of finding and buying the property. But this creates a really interesting and potentially tricky situation, right? If a GP gets paid just for buying stuff, are they motivated to find the best deals or just to do more deals? That's a critical question you've got to ask.
Next on the list is the asset management fee. Honestly, the easiest way to think about this is like the GP's salary for managing your money. It's an ongoing annual fee that covers their overhead, their strategic planning, and, of course, keeping you in the loop with investor reports. This is what keeps the lights on at the GP's office. And oh yeah, the menu doesn't stop there. As you can see, there are often separate fees for things like property management, overseeing any big construction projects, and even a fee for selling the asset at the very end, the disposition fee. Each one pays the GP for a very specific operational piece of the puzzle. But here's the thing, all those fees we just talked about, they're mostly just for covering the GP's cost of doing business. The real incentive, the part of the deal that can make a GP an absolute fortune, is something else entirely. It's called the promote, and you can think of it as the ultimate performance bonus. 20%. Just let that number sink in for a second. It's the most common number you'll see out there. And what it means is that after you, the investor, get all your money back, plus a decent return, the GP gets to keep a whopping 20% of whatever profits are left over. This, right here, is the grand prize. And this is a really crucial distinction to make. The promote isn't technically a fee for a service. It's a direct slice of the profits. And that's why it's so powerful. It's supposed to be the main tool that aligns the GP's interests with yours. They only get that massive payday if you get a great return first. But, and this is a huge but for you, the investor, there's a critical protection built in. The GP can't just start taking 20% of the profits from day one. Nope. First, the investment has to clear what's called a preferred return, or a hurdle. This means you, the LP, have to get paid a minimum return, usually around 6 to 8% a year, before the GP is allowed to touch a single dime of that promote. So how does all this money actually get paid out in the right order? Well, the mechanism that controls this is called the distribution waterfall. And it's a great analogy. Just like water flowing down a series of pools, the money has to completely fill one bucket before it's allowed to spill over into the next. So here's how that flow usually works. Step 1, the most important one. You get 100% of your initial investment back. Then step 2, you receive your full preferred return. Now step 3 is where it can get a little confusing. It's called the catch-up. This is where the GP gets a much larger slice of the profits for a little while until their total take catches up to that 20% target. And only after all that happens do we get to step 4, where all the rest of the money is split in that final 80-20 ratio. Now you gotta know, not all waterfalls are created equal. You basically have two main flavors. The American waterfall is by far the most investor-friendly. With this one, the GP only gets their promote after all investor money and the entire preferred return across the whole fund has been paid out. The European style, on the other hand, is deal by deal, which is definitely better for the GP since they can get paid on early wins even if other deals in the fund end up losing money.
So, to protect investors in those European-style deals, there's often a provision called a clawback. You can think of it like a safety net. It basically forces the GP to give back any promote they were paid on early successes if the fund as a whole doesn't end up clearing that preferred return hurdle.
Okay, I know that was a lot of mechanics. So let's turn all this theory into an actual actionable playbook. What should you, as an investor, be looking for, and what should make you run for the hills?
All right, here are some major red flags. Watch out for fee stacking. That's where a GP tries to charge you multiple fees for basically doing the same job. A weak GP co-investment, anything less than 1%, is also a big warning sign. It means they don't have much of their own skin in the game. And of course, if the legal documents are super vague about how fees are calculated, well, that's a pretty good sign you should be extra careful. So on the flip side, what does a great, well-aligned deal structure look like? You want to see a meaningful GP co-investment, at least 3 to 5% or more. You want to see that investor-friendly American waterfall. A high preferred return, maybe 8 or 9%, is fantastic. And just total, complete transparency on every single fee. The key is, you want the GP to make their money when you make your money. And this right here is why all of this matters so much. Let's say a project does really well and generates a 15% gross return. That sounds great. But after you subtract all those fees and that 20% promote for the GP, your net return as the investor might be closer to 11.5%. This fee drag is very real, and it's something you have to understand before you ever sign on the dotted line.
So as we wrap this up, it really all comes down to this one single powerful question you should ask yourself about any deal you look at. Look at the fee structure, look at the promote, and ask, are you paying this manager for delivering true performance, or are you just paying them for participating? The answer to that question will tell you absolutely everything you need to know.